This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of the show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Nick Spiller, podcast host and fundraising coach at Beta Business. Through multiple episodes per week, as well as in-person events, Beta Business helps entrepreneurs gain practical tactics and meaningful connections for starting their company. Nick, thank you for joining us.
Hall, it's good to be here. Thank you.
Great. So tell us more about your background. What did you do before you started investing in early stage companies?
Well, I grew up in Michigan, small town outside of Flint, and learned what it's like to live in a city that isn't very entrepreneurial. I was very fortunate, got into the University of Texas at Austin, moved to Austin over a decade ago, and have been involved in the startup community ever since. I got started at UT, was the founder of the Longhorn Entrepreneurship Agency. Was one of the first people on campus to meet Dr. Bob Metcalfe, who was a professor of innovation and inventor of the Ethernet. Dr. Metcalfe sponsored the Longhorn Entrepreneurship Agency. We call it LEA. That was at the same time Capital Factory was starting. I took Josh Bayer and Dr. Metcalfe's class at UT alongside that. And that led me to a long road of helping build the startup community in Austin. I spent a long time at Capital Factory specifically and just very involved in that ecosystem, both as a staff member, but also as an entrepreneur, getting supported there. And that's how I got here.
Great. So what excites you right now?
It's an interesting question. I think what I've always been focused on and thinking about is this next generation of investors who grew up with smartphones. And right now you look at just say family offices or a lot of the successful entrepreneurs, and they're really it's in the baby boomer generation, right? And people that didn't grow up with the internet, and they made money in very different ways. And I think the pandemic was really the start of this massive transition of wealth from the baby boomers to millennials and Gen Z. And I think that's going to unlock a lot of investment capital, really LP capital that will go into venture funds and even people in these families that will become VCs internally, because that's what they want to do. And it's exciting work. And it's just very different than say drilling an oil well or investing in real estate, which is where a lot of, especially here in Texas, where a lot of that wealth is sitting. So, I kind of view my job is to help those individuals who are looking to get started in venture, do it in a way where they're highly connected to other investors. They get connected to a lot of startups, and they don't end up, maybe I think what we don't want to happen is having them invest $1 million in one company that their friend at the country club introduced them to, and have that, go down the drain 12, 18 months later and kind of have a bad experience. So I think I get very excited about new investors having good experiences in the startup community.
Great. And so you see a lot of startups and a lot of investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
I try not to give them any direct advice. I don't want the SEC to come after me. That's something I think a lot. Not, I think they would, but but what I would tell investors if I was an investment advisor is it doesn't have to be a unicorn. And the reason that there's this unicorn exigence is because there's really big funds out there, $100 million, $1 billion funds that need to return 3x their capital. They know that 20% of their returns will come from 80% of their portfolio. And that creates this, and their customer, the endowment or pension fund that is funding the venture fund, they're looking for the highest rate of return from the venture asset class because it's so risky. And so there's just the fund model creates this huge exigence for like high scale, multi-billion-dollar companies. And as an individual who might have $1 million or $500,000 to invest, I don't think that's the game I'd go play. And I would look at how do I get involved in well-priced deals that could potentially grow to $50, $100, $250 million in revenue, but has an exit ramp at $10 million in revenue or $20 million in revenue. And that could still, for example, if you say invest $1 million on a $5 million valuation, maybe do another 3 at a $10 million valuation, then you could sell it, $10 or $15 million for 2x, 3x, 10x revenue multiple and still have a pretty good return for your investors, and just takes a lot more optionality, or it gives you a lot more optionality as an entrepreneur. Whereas if you go take, and an investor, but you go take, say, 10 million on 30 million as your first round or 50 million, then you're not going to sell until you hit at least, $50, $100 million in revenue. So that's kind of my message I'm trying to get across, but frankly, no one really wants to listen to it. At least on the investor side, there's a ton of founders that are like, that makes so much sense. I would love to do that. But then I try to introduce them to investors. And really the first thing that they tell the founders, oh, this doesn't have, unicorn potential.
Well, so is that your advice for people running startups? What's your coaching to them for this?
I always try to get them to do the math. And I think there's this almost, I think in some situations, let's say, I think if you're maybe a young entrepreneur, you're 20, 25, and you've got an app that's growing super fast and you maybe don't even know how you got there, maybe don't do the math and just take that big check from Sequoia or Andreessen. And I've seen that happen. I think it's great for younger people. But if you got to worry about your family, paying your bills, right, investing in college funds, I think you want to understand where the off ramp is, and you want to understand the life cycle financing strategy of your company, and essentially perform a return analysis and say, hey, there's a spreadsheet. I have a spreadsheet that I fill out with the founders I coach, where it's okay. Here's round one, and it's at it's a $2 million round, and it's at this valuation. We've got this option pool, and maybe it's a safe, or maybe it's a price round, and then here's round 2, round 3, and here's the exit. And then you can toggle that and see, here's the return if you sell for 10 million, 50 million, 100 million, and at least know what you're signing up for. And I think a lot of people don't really grasp what it takes, how hard it is to get a company to $100 million in revenue in 10 years. And what that means from a growth, you do that math also. It's just what growth percentage do you need for 10 years to take your company to $100 million in revenue? And then you can talk the percentages too. I can talk them through, right? And you've got 30 million small businesses in the United States. You've got, from reports I see, the National Small Business Association, about 7.5 million of them report inadequate access to funding. And there's 10,000 companies supported by the venture industry. And inside of that 10,000 companies, there's 0.02%. This is an older metric. I bet it's actually a little higher now with all the mega rounds, but 0.02% hit a $100 million valuation, and 0.01% hit $1 billion valuation. So you got to understand the math. And if you go through that with me and you're still like, yeah, I risk it, I'm going to be the next Mark Zuckerberg, then more power to you. I love the confidence. I think, you very well may be there. But what I found is a lot of entrepreneurs are very interested in a more modest journey, and they really just want to they're usually just worried about one round of funding. It's just like, man, if you could just give me $1 million or $2 million, I could do a ton, and I could put this business in a very sustainable state, or growing state. It's like, no, really, once you get on the treadmill, with the traditional VC model, you got to keep taking that money and get to scale to the point of that outsized return that I talked about at the top of the episode.
So true. And so let's talk about the state of investing in startups. How do you see the industry evolving from here?
Yeah, it's a great question. I think there's a massive concentration of capital. You've been looking, venture, emerged in its current form, mid 80s, and institutions like the Yale Endowment have had incredible returns. I mean, just like really shake the institutional investor world. And so you see some aggressive investing on behalf of these institutions into venture, especially the ones that are in these top tier funds. And so the report I look at is the National Venture Capital Association's Venture Monitor, and it shows last year was a record year for deal value. This year is doubling that year, and the rounds are getting bigger and bigger, and the deals and the valuations are getting higher and higher. At the same time, the deal count is arguably declining. If not, it's staying about the same, which means you've got essentially the same number, a small number of companies getting more and more money, and so you're kind of creating this. I think really this different asset class. It's not even really about startups anymore. It's about grow ups, and it becomes really hard for that venture ecosystem to help the entrepreneur that's in their garage that is just kind of tinkering around. There's I think needs to be a whole new asset class, whole new type of investor that can safely invest at the true startup stages where you don't have any revenue, or you've got some but there's a bunch of problems, or you might be really good but you're just not as good as the other companies that are trying to get venture funding.
Right. And what do you think is the biggest change you'll see in, say, the next 12 to 24 months?
It's a great question. What I've seen happening is this migration of venture capital across the country. And you used to see about 75, 80% of the VC funding going to Silicon Valley. I think that's far lower. There's 5 cities seem to have like really emerged as the rising 5. There's, I think, almost every city over 500,000 people is going to have a vibrant startup community. That's happening, right? And then moving forward, because of this decentralization of the startup community, I think the local geography piece of it is going to go out the window. Also, we have the pandemic that's already jump-started this and forced us to work remotely. We're doing this podcast remotely. Teams have been established remotely. People are turning nomadic, and at least people I see that are spending 3 months in one city and 3 months in the next city, and they don't even have a home base. So I think it's not that Silicon Valley or Austin or Chicago, Miami, Denver, it's not that they're becoming the next Silicon Valley. I think it's really that Silicon Valley is spreading out across the United States. And as that happens, it kind of gets infused with the local business culture like it has here in Austin or in Indianapolis or Charlotte, et cetera. And then I think that's really interesting prospect. And there's certainly amazing pieces to Silicon Valley. And then, again, getting back to my more modest outcomes, I think, that's where you get these local communities like we have had here in Austin and across Texas that could kind of couple with that to, maybe, bring the upside down a little bit, but also, protect the downside and keep it a little less risky, a little more reasonable and predictable for an entrepreneur who is trying to feed their family.
Great. So let's talk about your investment thesis. What is it, and what's your criteria for making an investment?
It's a good question. I try to get into good deals that I shouldn't be in. And I think it depends on the stage. I'm starting to get more involved at the later stage. I like that. And as much as I just talked about investing at the earlier stage, like when you have your investor hat on, it's far less risky. You could put more money to work. Like some of these family offices, bigger funds, it's just easier for them to do those deals because they need to. And so I think and there's a lot of seed funds, smaller seed funds that have pro rata that they can't fill at the later stages. That's what I'm trying to get in on and try to make those deals. And I'm very agnostic. Being at Capital Factory, I got exposure to every industry, every stage. And so I'm really comfortable, everything outside of the FDA essentially. And at the early stage, I'm very focused on the University of Texas, and that's just my network. And I've built both the Longhorn Entrepreneurship Agency and Genesis. And there's a company we're about to announce we funded. It's a student company. I'm really excited about it. It's called My Workout Group. It's a student who wanted more accountability for working out, something we've all tried or like seen a lot of people take a stab at. He, using TikTok, built an audience before pre-launch and is very engaged, kind of went viral on TikTok and launched his app. Within 3 hours of launching, achieved the #1 spot on the Apple App Store in the health and fitness category. And so it's like companies like that, it's just like, man, I see 50 student startups a year or graduate students or even alumni that are starting through the Longhorn network. But that doesn't happen very often. I've been looking at UT startups for 10 years. And yeah, I've never seen anyone get traction with an app that fast. And so I think that's a big focus of mine. And yeah, but very, very generalist and opportunistic, I would say.
Great. Well, you see a lot of startups and a lot of investors. What do you think is the main challenge that startups today face?
Getting face to face with investors, for obvious reasons. But I think there's no better place to start a relationship with an investor than a cocktail party. And I think, investors run in circles. And if you can just get in that circle, they don't ask how you got in, but you just have that credibility because you showed up. I've been fighting through this whole pandemic with founders reaching out on LinkedIn and Twitter and calling people. And it's a lot harder. Whereas, before I could go throw a party and have 20, 30 investors show up and then have the same amount of founders and create 100 connections in an evening, and so, yeah, I think as long as we can remain safe, we need to get very focused at having little small gatherings. It doesn't even have to be big. I think it's better if it's only 30 or 40 people, maybe 20. I'm about to take 10 entrepreneurs to Marfa, Texas in a month. And I think that'll be a magical experience for everybody and something that will probably be refreshing that, we haven't done in a while, a little in-person retreat.
Right. And so on the other side of that, what's the challenge the investor faces in today's market?
Depends on what type of investor you are. I would say, as a individual angel investor, smaller seed fund, I think you really, risk not having enough money to play ball downstream, and you can get in these deals. But if it really takes off, then the big funds start coming and they're putting $10 million check just to start. And then 30, 40, 50 million and even before there are secondary opportunities. So I think that can be a little tough. And yeah, I think we're also, on the horizon of rates going up from the Federal Reserve, which will probably taper what's going on in the stock market, potentially cryptocurrency. Yeah, I think there's a lot that could happen that's not great. And I think that like the ramifications of COVID we've had like kind of a Band-Aid on it. And I don't know, I kind of have the Titanic theory of, we kind of knew that something bad happened 2 years ago, but it didn't quite feel as bad. I mean, obviously it was bad from a health perspective, but from an economy standpoint, we've been making more money than ever. And, rates are going through, been very low. And, but kind of there's been slowly, there's, been levels of COVID that it's almost like the chambers in the Titanic. Every 3 months, there's some new effect. We're experiencing supply chain in LA right now. And yeah, I think like I'm looking for the point where the ship breaks, right? And if it breaks in half and there's an event that happens, I don't know what that could be. And I don't want to speculate on the show, but if something like that happens, I think you're kind of in for a cold winter, and hopefully you will have raised money for your company right before that, or raised money for your fund right before that. Because we're on the longest bull run in the history of the economy. We've had, very not so great situations and outside in the world. And so, yeah, I think that's something that you got to at least be thinking about.
That's a good point. Market just can't keep going up forever. Eventually, it's going to have its cycles to go through, and it'll be a different world then for sure. So that's a good point. Well, you see a lot of different sectors and applications out there. If you had to pick one or two that you think are good opportunities for investors to pursue today, what would you call out?
I got to call out CPG continues to impress. Austin's a great example of a city that's branded itself as a tech company, but has made all its money in CPG. And you've got Yeti and Kinder Scott. And I mean, there's a long Tito's Vodka, long list of unicorn CPG companies that, the tech community couldn't even touch. And it's just also just the way people are buying seems like I remember it's probably 2010 when like the first Black Friday of maybe that I remember, or just period, that Facebook was around, right? And like it was just underwhelming. Like there wasn't a lot of stuff bought through social media. But I think we're like way past that now. Like people are buying stuff through social media, based on what teenage influencers are wearing and their TikTok reel, right? And so it's created this like just a very powerful channel to the customers. Is actually more scalable than SaaS, or particularly you look at a company like Hims. Became the fastest company to $1 billion valuation as a CPG company, faster than any SaaS company ever did. And I think it's just if you can strike that nerve with people out there that care, it can just be so fast that you grow. So yeah, CPG is big, and I think, but really across the board, I think software seems to be combining, like hardware seems to be really becoming easier and more acceptable than it was maybe 5-10 years ago, where everyone would say, oh, hardware is really hard, we don't want to fund it. But I see it's almost half of the software companies I see now have some type of hardware component, and VCs seem way more open to that. And so I think that's, like what we're going to see. Icon 3D is like the big one in Austin that's just announced they're partnered with Lennar and are building a whole 3D printed neighborhood in Austin, which is super cool. And a company I got to help manage our investment in at Capital Factory. I think robotics, hardware, and then also CPG are really hot. But right now everything's super hot. I was just on the phone with an investor. I'd say get while the getting's good. That's my take on it.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I have a podcast of my own. How do you like podcasting, Hall? Do you find it enjoyable?
I enjoy it. I get to hear great stories, meet new people every day. I started because I wanted to capture the knowledge of investors into some format to reuse it. Because when I ran Angel Networks, what I saw is they would start a new group, spend the first 3 years, everybody getting educated and learning how to do it. 4 or 5 years, they'd do a little bit more work, and then they would step out, retire, whatever. Here comes the next group, and they repeat the whole cycle all over again. They spend the first 3 years learning and when I talked to Angel Group leaders, that's what they told me. They said, I wish I had something that had more institutional knowledge so we could not have to go through that learning cycle every time that we do it. So that's why I do it myself. And I enjoy hearing stories, telling stories, and so forth. And it's a great way to do that.
Yeah. It was similar for me with Beta Business. My partner, Grant Girton, and I had worked with hundreds of entrepreneurs, if not, probably maybe I might be over 1,000, but definitely hundreds. And you develop these very specific thoughts on things, and my delivery seems so inconsistent. And I love, the podcast as we get on there for 10, 15 minutes and we give very direct advice for entrepreneurs. And it's things that we've tried and tested on our own companies. And it seems very effective for getting that piece across. It's almost every conversation I have with a founder, I can say, well, I'll tell you what I can tell you right now, but you need to listen to the podcast, because then that's where I thought it out and I wrote out the advice. And we've also started doing some interviews as well to couple with our direct advice episodes. We'll have to have you on, Hall, at some point. And that's a big thing I've had going on. I'm also, if anyone's interested in barbecue, I've started a competitive barbecue team during the pandemic, and I'm now an award-winning pit master. I got a silver medal at IBCA sanctioned cook-off, and so that's the other side of what I do in my weekend job when I can, is go out and smoke brisket and sausage and all that.
Sound like you're having a great time there with it. Looking forward to the podcast itself. For listeners out there, how best to get back in touch with you, and how can they find that podcast?
Yeah, you can find the podcast Beta Business on Spotify or really any of your favorite podcast players. And I am very accessible on LinkedIn. That's what I'd go with. So reach out to me on LinkedIn. I get back to everyone, even the people that just spam me with their deck. I usually respond and talk to them as well, because I love meeting entrepreneurs and usually find the first conversation I can be the most helpful.
Great. Well, we'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Great. Thanks, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.